Ryan, this is part two of this pre-seed deck. They are trying to raise 500K. And as always, you are Chief Marketing Officer, one of the founding members here at Startups.com. We're going to be talking about the go-to-market strategy. And once again, part one is going to be available online for those of you who are going to be catching this on the replay. But Ryan, I wanted to talk today about something that constantly comes up when we are talking to investors or founders are coming, and that is the concept of a strategic moat. In terms of multiple number of startups that you've worked with, you've been here much longer than me. You're an OG. Using our capital raising tools, we've got this new tool out there called investor matching, and we've got quite the history. Over a million startups, 20 billion raised by those startups. Full disclosure, we're not the ones raising the money or writing the checks. We're helping them and enabling them go on. Just got a wonderful note from a founder last night. I would like to say I thought it was a sure bet because all the signs were there. We helped the founder get into Jason Calacanis's fund and
Nice.
do a pitch competition. Spent a lot of reps coaching him how to answer, how to set it up, pitch deck, honing down his business idea. He got in. I think he got the initial $25,000 check. He sends me this email. We finished our seed round, $2.6 million, showed me all the funds, gave me the receipts.
There
That's
we
a
go.
great feeling, Ryan, right?
Yeah,
And
always.
what's that been like for you with all these startups that have gone on? What are some of the, glory stories or some of the better experiences that you've had?
Oh man, there's so many of them. That's the thing. Like it's and look, I think I fully embrace something that Will and I talk about a lot on the podcast, which is that we have to celebrate all these little moments. So while I love hearing news come in around a funding round and that somebody's achieved their fundraising goal, I get just as excited when somebody comes back and like, remember that thing we talked about a week ago where I was completely stuck with Facebook ads and I couldn't get a single person to book on my calendar? I've got 10 this week. I get just excited about that stuff because that is the stuff that leads to the bigger outcomes. And so seeing the groundswell, seeing all the little stuff happen. Look, I love a funding round. I love a successful funding round as much as anybody else. I love an exit as much as anybody else. But those come few and far between, right? In the life of a
Very
startup.
true. Very
And
true.
so I think that what I have found a way to do, and I try to help other startup founders do that, is to just find the little things in every day that are motivational, that are the wins, or the understandable losses that we can come back and tackle again and win against tomorrow. And that's really where I'd say 80-90% of my joy, not because I don't get really excited about those other things. It's just a lot more of the little stuff. And I truly embrace all of it. Right. I had a founder that had been struggling with email for some time, was doing a great job of grabbing email addresses, great job of getting people to sign up. Crickets when it came to moving them further down the funnel. Right. Great grabbing emails, not getting any action out of this email list. And we worked on it over a couple of week period. And now all of a sudden we're up to like a 45% open rate,
Nice.
25% booking rate, and they're starting to see some traction. So that stuff matters a lot to me.
Two more questions for you. This is going to be
Okay.
renters. Here's a bit of a preview. We're going to go through these slides, fairly nicely done deck in terms of just great simplicity.
Yeah.
There's an interesting thing about traction here, but then also we're going to miss out on the go-to-market slide. It's got a highly competitive slide here in terms of lots of entrenched competition like Zillow
Sure.
Group. Huge, right?
Yeah.
And founder, good experience. They're seeking to raise 500K. And here there's some projections. Ryan, my first question to you is how important is it from an investment perspective? Let's just take for granted getting customers is a good thing. Founders know this. But how important is it to have some type of unique insight or a hack, some way, some strategy? Like we know how to do email differently than everybody else. We know how to do Facebook ads or social differently than everybody else from an investor's perspective.
Super. Right. Like this is where we get to sort of show like what maybe that unfair advantage looks like. That
Got
reason
it.
that we're going to be able to go to market, particularly in a highly competitive market, which at some point most of them are, right? We're at least competing with status quo or what other people are doing right now, which I think often gets left behind. You're like, there's nobody doing exactly what we're doing. Who cares? What are all the people that you want to serve doing right now? So when we can show how we're going to do something differently, and we have a bit of secret sauce to that. Let's say this differently. A perfect, because you did ask something about a moat before too, and I think this kind of speaks to that.
Sure.
From a strategic standpoint. If you can show me that your go-to-market strategy is essentially invisible to your competitors, but highly visible to your market, this is amazing. Now, it doesn't have to be a grand scale yet, right?
Ooh.
But essentially what I'm saying is Is there something that your competitors are absolutely not doing, can't do, won't do, haven't done, whatever that is, that you're going to do even better, have already done, and can show me that you've already done some of this? This is where things get pretty exciting, right? As an investor, this is what we're looking for, just to say, like, okay, we're not going to go outspend Zillow Group on Facebook ads, because we're not. Right? Like, well, if you'll just give me about $450 million, we can beat them in advertising. Yeah, we're not going to do that. We're not going to go test that. If you can show me there's a little known channel, or there's some wiggle room somewhere else, there's something that they're not doing, and that's what we're going to go after. And we've tested this against the other possibly viable channels, and this is the one that's working. Now you've got something.
I could definitely attest, when a founder shows me that they're a ninja when it comes to getting customers and they're able to sneak in, silent assassin, that
Yeah,
gets me excited.
that's it. The best go-to-market strategies, again, they're invisible to competitors, but they're obvious to your customers, right? But then again, that go-to-market is your hypothesis, but the traction slide is the proof, right? And I want to see both where possible.
We talked about Zillow Group and Move Group, Realtor.com, Move.com. They're building these strategic moats. Ryan, explain to the audience. Let's talk about this. What is a competitive moat, strategic moat, moat in general when it comes to startups, and why is it important?
Yeah, something that's hard to cross from a competitive standpoint, right? That's the entire point of a moat, is that it protects you from incursion by outside force, right? We used to build them around castles. I never built one. Never had a castle. If I had one, I definitely would have had a moat. A lot easier to just dig a moat, right? So in the case where we're trying to defend digital territory, it's a bit harder.
Sure.
And so we have to think through, like, what's that look like? What are some things that we can do that, again, the competitors aren't doing, can't do, won't do, or would be hard to replicate? And we're starting to hear this a lot. I'm sure I will say this a lot now, and there's probably very few people who will hear this now that haven't already heard this. Tech and product are becoming a lot less of a moat, because it's getting really easy to build and really easy to replicate. If somebody else has already built it, it gets even easier to just go and copy it, duplicate it. So if they are a moat at all, it's a very, very short-lived, short-term moat. So we want to think through, what are the things that we can do that serve as moats? Some of those things are hard and long-term builds, like your brand. If you are known as a quality, reputable brand that does the right things and does them well, that's a great moat, because that's something that other people can't just step in and go, I can't just start a shoe company tomorrow and be like, my shoes are as good as Nikes. Everybody's going to be like, sure. No, they're not. I'm going to go buy some Nikes. On the other hand, you've got things like community, just your relationship with your audience.
That's a big one.
Brand is involved in. Things like your email list, those used to be a lot more powerful. Your followers, those can be relatively easily duplicated, stolen, borrowed, and worked over. So there's a lot of things that I think were traditionally thought of as moats that aren't necessarily. Team is one that used to be, I think, considered to be a stronger moat. Again, now with AI doing some of the stuff that it does, the ability to duplicate what somebody really talented in another company is doing within your own company just became a hell of a lot easier, right?
Oh, man, crazy. It's crazy what's going on. Or Mark Zuckerberg swoops in and gives a $250 million signing bonus.
I mean, some of these things are just utterly ridiculous. Just absolutely nuts right now.
Okay, let's talk about another scenario, Ryan, because I look in our audience and I think about the ones raising at Startups.com. And a lot of them, a lot of founders go for VC because they don't think there's any other option. And venture capital, everyone, is a subset of private equity that deals in alternative assets and is a highly risky subset. It's just, but everybody thinks that's the way it gets funded. And truthfully, there are literally dozens of other ways businesses get funded. But I can tell you a story. We both know this founder. This founder, one of the success stories here, launched, I believe, raised $3 million on roughly 9 million, post, went out there, and they were involved in helping people. And I don't want to give away too many details, but I've been spending time. He just recently sold the business because he had to. And he said to me, Ed, in the beginning, I remember him talking to the investors, and they were like, we just don't think you've got customer acquisition on lock. They were using, I believe, Google Ads back then. They scaled enough and they got the money. And he said to me something really interesting, Ryan, which I don't think many founders get a chance to learn, but I was glad he did. He said, Ed, if I just wouldn't have taken VC money, our business would have been fine. We would have made solid money. We would have been doing, $5 to $10 million a year. But because we took VC money, we were being pushed to unicorn status and we couldn't figure it out. And I use that as a tale of caution to everyone and say, why try and do $100 million a year unicorn, UNICORN, when you could do a unicorn, YOU unicorn, and not take that type of capital, because then you don't have to have as much of those strategic moats and those insights and those ninja moves and scale it that much. What are your thoughts on that? Because I think this is something that everybody should hear.
We talk about this a lot, and Will and I have probably touched on this. I mean, when I say touched on, there are 3 podcast episodes that I can think of that sort of directly speak to this. The core theme here is that it changes the optionality of the founder. The minute you take on venture funding, there are only 3 outcomes that matter to them. Another round big enough where they can get some liquidity.
Exactly.
Acquisition. Those are the only 3 ways they get paid.
Right.
So those are the only 3 things they care about. Now, there are a massive number of businesses out there that are just puking cash into the founders' accounts year after year after year.
Yeah.
Maybe these are 8 million, 12, 15 million failures by venture standards, but some of these businesses are on like 40, 50% EBITDA. Those founders are very happy with what's going on there.
Exactly.
But you can't do that. None of them have taken on venture funding, because if they had, they'd be told, cool that you're running a really profitable business right now. No, you're not going to distribute any of that to yourself or anyone else. What you're going to do with that is reinvest it and try to drive hellaciously difficult growth that will benefit us in one of those 3 ways we already talked about. We got to go public. We got to get another big round in where we get some liquidity, or we've got to get acquired. Those are the 3 things that matter. And so all of a sudden, all of these other save points, stop points, exit ramps from growth into just stability and profitability are closed to you. You now have to drive. You've just moved the only allowable goals so far out that it becomes extremely difficult to achieve that level of success and to benefit at all, right? In order to benefit at all, you have to win big at that point. You cannot
Absolutely.
just hit. You can't win on base hits at that point.
Yeah.
If you're not funded, you can absolutely win on base hits. In fact, most of the really wealthy people I know didn't have a massive exit. They had mini exit after mini exit, year after year after year, simply by being able to extract profit from a well-run company.
I wish every founder would get the experience of just going and having a breakfast with another venture funded founder that talks about the pressure and the stresses they feel. And
you want to know why that'll never happen, Ed? You want to know why that'll never happen?
Why is that?
Venture funded founders don't have time to go to breakfast, Ed. They are busy building companies. They've got to grow. There are metrics to be had.
Yeah. And when I talk to venture funded founders, I actually feel so much better about my life and the meager, dollars that I'm making compared to the money that they're expected to make, the board, the people on their cap table. I feel better about my life. I actually de-stress talking to these founders.
Let's look metaphorically. Like, I love to play soccer. I've played my entire life. I enjoy the sport a lot, and I've continued to be able to play. Thank goodness, right? I still play. If the only conditions that would have allowed me to keep playing were that I made it into the Premier League or MLS or something like that, I had to go pro, it would have taken all the fun out of it. I would have burnt out a long time ago. And I probably legitimately wasn't talented enough to do that. Right. And so I would have failed somewhere, statistically speaking, 100%, right? Not 100%, 99.999%, right? Just because that's the odds. Statistically speaking, I wouldn't have made it. And it would have taken the fun out of it had I made that the success requirements. If the success requirements are massive success or nothing, right? It's like if you expect every kid that bounces a ball to become an NBA star, or you treat them as an abject failure, that's tough, right? I don't like conditions like that. Success can exist on a spectrum, and especially in a game as hard as building a business, it should. The minute you take away the spectrum, then you're just pointing towards one pole that is extremely hard to achieve. You're far more likely to end up at the other pole, which is not that hard to achieve, which is just failure and bowing out.
Well said, Ryan. I just went through my own episode of Startup Therapy. Everyone,
Startup Therapy Mini every Wednesday with Ryan and Ed.
Ryan and Will record Startup Therapy. It's a great podcast. Make sure you go check it out. It's actually one of the main reason that I'm here at Startups.com, because I was listening to Startup Therapy after a real tough emotional co-founder breakup. Let's talk about this deck here, Ryan. I'm going to let you know. Will graded this deck a B.
All right.
So a better deck than what we're normally used to seeing when we do this. Credit to this founder, has put in the reps with Will. I've spent time on this. So let's add some finishing touches. But as I said, we are missing the go-to-market strategy slide. And that's what I want to impress upon the founder. So I'd like us to workshop that a little bit as well, and you to give him some advice. Let's start off with the cover slide, rental marketplace, rental marketplace, utilizing end-to-end native AI to yield efficiencies for renters. Your initial impressions.
Well, tech words, bro, but how do you beat Zillow and CoStar distribution?
Right.
No. So look, nothing wrong with this necessarily. The thing that it does is it tells me a little bit about what it does and not really what it does for the end user. Like, tell me what happens, right? yield efficiencies for renters. Does it save them time or money? If it does, say that. Say that it
Exactly.
saves them time and money. We don't need to yield efficiencies for anybody. But I'm being pretty nitpicky now. This is going to be a great deck, so I feel like we should be nitpicky because that's how we make this from great to greater.
Right. We'll have the exact same feedback. So I think that's something that we're going to put on the list here. It says nearly 24 million renters move each year, wasting $1 billion on rental application fees, places they never had a shot at.
Good quantification. Sounds big. A lot of money.
Straightforward, right?
Feels okay. Yeah,
Right.
pretty straightforward. I don't know if there's anything here I'll want to see like, yeah, no, I think we're okay.
Yep. Now we're going to get more feedback. We're going to see, and for those of you who missed the first episode, you're going to see how and why this could be improved based upon later factors we get into.
That's what I was trying to keep myself from jumping ahead to. So
right.
If they tell, right. So let's keep whizzing through here and see where we get.
But in terms of simplicity and just really straightforwardness, we know who has the problem, how many there are, why the problem exists, and what the cost of that problem is. Straightforward. And Will really talked about how this language is straightforward in terms of applying to places they never had a shot at. He said, might as well highlight it using that language versus because the industry is fragmented with outdated tools and etc. It's just straightforward, the pain of the user, which is great.
Yep.
One pre-screened application that matches renters to units they actually qualify for. Saves time, saves money.
What I'd like to see here is more of a reversal of the problem. So if we jump back to problem really quick, we're talking 1 billion rental application fees, blah, blah, blah. Okay. So jump ahead again now. You think I could hold 15 words in my head from slide to slide, but I can't, Ed. I cannot. So this is pretty good.
It's right? Close, right?
Yeah. So I think it's a decent reversal, right? You might want to, go back to, saving them time and money. But it's implied here. Oh, it says save time, saves money right below. My God. I was ignoring the visuals. Is it just me? And again, like this deck is so nicely done. I'm going to be nitpicky here. The layout of this feels very clean, very pro. The saves time, saves money. The little sign and the little bag feel a little clip art compared to the rest of the design of this thing.
Yeah, I think it's a choice. But here's where I do agree with you. I think you could have just incorporated it all into the headline and highlighted it, right?
Yep.
It's a choice.
A picture's worth 1,000 words, but we've only got 2 words in each of those pictures. So probably not great use of a picture.
Right. Let's go to the market. This is where it gets really interesting. So in the end, we contested the market. So we said, okay, we understand that 24 million renters relocate annually at 12 billion, if that's what it costs them in application fees. And I like the fact that it is bottom up. So 24 times $500 is what this works out to.
Okay.
What was really important, everyone, for all of you, is to put in the unit economics of this, explain. So typically, and I said this in the last video, everyone, if you're going to use a TAM, SAM, SOM model, put your TAM and put the number up at the top, 12 billion, and then below it, explain the math. So the number of people times how much money, and you just explain it and then give a little explanation why. But here's the thing. The targeting audience renters who submit applications for rentals they do not qualify for 1 billion, we brought that into question. Ryan, we thought that this actually is the TAM that we should be saying we want to handle all the people who apply for places that don't qualify, because a lot of these individuals, they might have really great credit, they might totally fit, and they apply once and then bang, they're in. So defining the audience, and this is where your go-to-market strategy chief marketing officer brain will come in, saying we're going to target the ones that have the pain and explain it from there. Walk us through how you would think about this.
Well, I think I do agree here, because I think that really does look more like the TAM, unless I guess it depends, right? So in terms of the total money saved, before we have these people submit application, we don't actually know which of the 24 million are the what must be 2 million who end up submitting applications for rentals they don't qualify for, right?
It is implied, though, because we're saying that somehow we've calculated that there are, and this is where not having the math, but I'm guessing that they know how many people, and let's pause just for a moment so I can break down for everybody who's listening. Having a TAM, SAM, SOM, or market slide without a semblance of a thoughtful, logical ICP is the death of all founders, where investors go, I don't understand. Like, if we're saying, let's say, for example, 24 million people apply, and let's just say half always like nail it on the first try, or they don't really have the pain whatsoever, they're okay with applying to 2 or 3 places. That's not your ideal customer profile. And an investor is going to challenge you on this. Why would you want to market to them? Why would you want to spend time with them if they're not compelled to do so, unless you can make an argument that even the ones that do get in, they still want to save whatever $250 is, instead of, applying to 5 places, they apply just once. And that's what's missing is we don't understand. Like, an investor's not going to sit here and pontificate on what your ICP is and what makes sense in your go-to-market strategy or your entire market, your TAM, SAM, SUM. That's what Ryan and I are doing. So I'm just letting everybody know this is the thought process of what we're trying to do right now to help this founder. Because we understand the problem, the solution is a compelling idea, but how do we really nail the market slide in a way where investors go, this founder knows what they're doing, they're talking about.
Will tends not to love Tam Sam Sum. What did he say about this one? That usually triggers him right out of the gate.
Yeah, we talk about that all the time. He actually recommended put it in a bucket and say, okay, imagine we've got people with 3 credit scores, A, B, C. Mm-hmm. And A, we're just going to ignore because B is more strategic and they have to apply to more people. And we'll say everybody in the B to C credit score tier, which I thought was compelling as well. We're going to focus on the C tier because a $50 application could break them, or they just don't have the funds, or they fall in low income, or somehow target where this becomes more of a common pervasive problem, which is probably why, as I reflect upon it, I've been thinking about this all night, probably why these places that have, landlords or property rental companies have to charge processing and administrative fees to apply because they're getting so much volume coming their way.
I'd be curious how many of them is that a profit center versus a cost center?
Exactly. I thought, how much is
this
it
might not be something they want to eliminate, right?
Yes.
This might pay half the salary of that front office person that otherwise wouldn't have a full-time job.
Now, let me pause. Everyone, Ryan said exactly what an investor will be thinking. Why would rental places with inventory want to sign on for this if they're just happily taking in fees? And this is what's called the idea maze, everyone, where this came from A16Z, Andreessen Horowitz, and they literally drop you an idea maze. And what about this? And what about that? And can you navigate these different types of nooks and crannies and dead ends? An investor will throw you these curveballs based on how they predict consumer behavior or the behavior of the market will respond to your value proposition.
In terms of how we break this down, the ABC credit level, it's an interesting concept. Here, the challenge I would still have with that is what we're trying to show with TAM, SAM, and SUM is the total market, the number of people who actually suffer from the specific problem that we're solving, and the number of them that we think we can likely service, right? We've done the SUM. The challenge in this case is I'm not sure how apparent that is until they've already applied, right? So will we be able to simply target the folks that we want to, right? You understand where I'm going with that?
I do.
Also,
totally.
there's another not so subtle challenge here. This all hinges upon the landlords accepting our unified pre-screening. If that's only for a portion of the population, and if it's the most problematic and hardest to place portion of the population, will they just start to screen all of those out? Will we just create a system where they go, if they come in through that, it means that they're probably credit challenged. It means that they're probably bad pay, whatever, right? So we don't want to create a race to the bottom of the barrel in terms of who we're bringing on as clients and who we're sending then on to landlords. Now, it is a service to them to be able to see those folks and maybe to go, anybody that comes in through renters.com, because of the fact that they're targeting these folks who were submitting applications for rentals they don't qualify for, if we're able to just get them to the ones they qualify for, great. But you see the challenge there, right?
I totally do. So let me throw a bit of a red herring in there, or, one of my options. Another way is, Ryan, double clicking what you said, you could definitely argue that all 24 million of these individuals want to use this service because applying multiple times, total pain in the tail. And if you've made this super convenient, great. So we're here. Then this one would make sense if we explain it a little more. Maybe it was something like, we're going to focus on apartment rentals because the volume far exceeds the ability for property rental companies to process, and they get on average like 30 applications per unit, something like that, where it made sense strategically. Now we're going to focus on the segment of the market that has that pain, willing to play ball, fits in your ICP, low-lying fruit, whatever metaphor you want to use. It makes sense for the investor strategically.
I think that will help a little bit with the ubiquity problem. because then you don't necessarily have to have one that would be accepted by everyone, but have one that would be accepted, generally speaking, the pre-screening, the sort of one app to rule them all, that would be accepted by the majority of this, assuming we can select apartment companies, property management companies that have similar standards and how they decide. That would be the other thing that we'd really want to understand here as an investor. I'd have a lot of questions around the likelihood of adoption from the supply side, right?
Right.
Totally get the demand side. They want to spend less time applying. They want to spend less fees. I don't know that supply side cares about that at all. They're like,
Yes.
we've got the houses. People need the houses. They're going to jump through whatever flaming hoops we put forth. And all that matters to us is that we end up with the best quality renters, the ones that are likely to pay and likely to renew and likely to cause the least problems. That's what they care about. And so the thing we didn't see yet is how well this addresses, or does it address a problem on the landlord side?
Great. And that's covered up. So we're going to talk about the traction in just a moment, where the founder, to their credit, has gone out and figured it out. We're still a little unclear, but before we get there, Ryan, I want to bring up something really interesting. I got a comment from a founder last night saying, I'm confused of your pitch deck guidance because it seems contradictory to what I heard from Will, I heard from this workshop, what I hear from your videos. And even now, Ryan, we just proposed two different ways. I don't think they were contradictory, but they could be considered sort of opposing each other, sort of on different ends of the spectrum in terms of how to approach this market slide. And you just brought up, Will doesn't like Tam Sam Som. I personally, big fan of Tam Sam Som. I don't know where you fit on this entire spectrum, but we're only here to give our side. Everybody looks at things differently. And because we don't know what's going to work, it's up to the founder to try and take some of these tools we put in their toolkit, try it. But we'll know when we see it. They may approach it a totally different way, and then we'll say, that totally makes sense. Talk about how many times you encounter this situation where they say, Ryan, you're giving me contradictory advice. That's not what Ed said.
Yeah, it's quite often, right? And it's what we're giving them is perspective, right? I try not to give advice. I try to give perspective. The two ways that we described ways of sizing the market are not opposing. They are different ways of framing some of the same information, which is exactly what perspective is. It's what happens when we look at the same thing from two different points of view. In one way, we can look at a market from a Tam, Sam, and Som. That's one way of dividing a total market. Market's the same, by the way, guys, regardless of how we describe it or break it down. How we describe it doesn't change the size.
Yeah.
Right?
Yeah.
The market is what it is. The likelihood that we got it right in Tam, Sam, Som, or however we're doing it, pretty low, right? Like we're guessing at it, but these are made up numbers. These are our best assumptions. And so what we're really doing is just saying, from an investor perspective, what is going to be the clearest way of helping them to see and believe in the market, right? Sometimes founders get confused, like, if I do it this way, it looks like the biggest number. Cool. Is it the most believable? Is it the most relatable? Is it the most understandable? Because that's what moves people forward. As far as where I stand, I don't have a strong stance on whether it should be Tam, Sam, Som, just Tam, just Som. Here's what I will say. The market slide, I need to see the Tam. I need to know how big the big part of the market is. And what I personally like is that through the go-to-market slide and the traction slide, that Som becomes apparent to me through the told story of those two slides. That's where it can be represented on the market slide as well. Those two slides are where that Som number puts its clothes on, heads out the door, gets to work.
Right. I appreciate you adding that in there. Everyone, please, those of you part of Startups.com who are planning on joining Startups.com, which we hope you all do, you consider that is one of the strengths of our community, that we're going to give you all these different perspectives, especially in market slide. Let's look at the how it works slide. We got 2 more slides, and then I want to talk about potential go-to-market strategy. There's a big chunk of paragraph here. Our AI agent is your personal relocation concierge. We're in just search bar, and this is more like just straightforward talking to the customer, pitching it, but it works through flags, sketchy of fake units, recommended deals, etc. We can read that. And so we've got these 3 steps. So we take AI-driven data, search results, automated applications, workflows, and secure document e-signatures, efficient for property management. Ryan, I just want to talk about, you understand generally, Will actually wordsmith this, ran it through ChatGPT Live, and basically came up with it. And we wanted to know, okay, how does this exactly work in terms of supply, the demand? I didn't see how they go get the supply. Do they go and scrape listings or things like that? But in general, it seems straightforward, a lot to be desired with this slide. Questions or thoughts in terms of how this startup works?
Yeah, if this is the how it works, this is again more like it's a bit more like what it does. I do understand that what they're basically trying to give us a little bit of a demo of the tool. If they're going to do that, then I think let's just let's just do that. I feel like a little screenshot, even a prototype here would go so far to just show me like put in your criteria, get filtered results, and show like the fact that it's eliminated sketchy deals and whatever,
Yeah.
whatever. And then what's the next step, right? Like rather than this paragraph, show me, right?
I,
Just
I laugh because you and Will are so in sync. He's just like, give me some steps. Like, I think he said Sally or Leah or something has
yeah,
to find an apartment,
yep,
etc. Submits, gets 50 hits from the inventory with one
yeah.
application, and then gets in there like for less, 90% less money and 2 times faster, right?
Yeah,
So,
that's exactly it, right?
yeah.
And that, so you bring up something 2 times as fast. If we jump back a couple slides there to the market, all we're talking about is money here, and that's why we end up the wasted money happens for the people who applied to apartments that they can't utilize, but wasted time theoretically happened for everybody. And so I think
Hmm.
that's where we get this line between Ham and Sam becomes a little bit more blurred, or it increases the Sam a bit if we look at people who also wasted time.
Good
And
point.
again, I'm going to say you want this thing to be ubiquitously useful, I would think. You don't want this just to be for people who wasted money because they applied to the wrong apartments. There may be a lot of reasons for that. Again, that might have been credit, a lot of stuff. So I don't want to dig into that right now. Okay, we can jump back to how it works. But yeah, I think just a quick little, where exactly do we insert into the workflow of all
Hmm.
of this? Like, when did Sally find us? Did Sally find apartments first? And then did Sally find out she has to move in a month?
Good point.
Right?
Yeah.
Where did all this happen? And who invites whom? Right? Is this something like if I go to a management company, is this integrated on their end? Did they push me through this process? Or do I start this on my own and then it goes out, right? So like what are the entry points into this? Because that matters, right? If I've already found a place I want to apply through, are they going to force my application? Because what if I've already made 5 or 6 applications, right? Is it too late to start then? So I want to know like where does this fit in the overall workflow, and who initiates, or can it be through double initiation? Can it start at either end of the process?
Ryan, you just triggered a thought for me about my own pain point. I fully admit I haven't rented anything in 20 some odd years. Ryan, if this is a service because people like move on a consistent basis that would constantly find places that fit me and then on my renewal date or closer actually ping me and say, hey, by the way, if you're thinking about moving because your lease is up in a period of time, these are all the places you fit. You do want to update your application. Oh my goodness, Ryan. I think that would have saved me a ton of headaches. But again,
Yep.
just my thought on this.
Well, it's an important point though, around the kind of how sticky is the product and over what period of time. It's great that 24 million people are doing this every year, but the thing that it glosses over in all of that is that it's not the same 24,000 people every year.
Right.
Right. I don't know what the average. There's a stat out there. I'm sure we can find it. It may even be somewhere else in the deck that says how often. I happen to know this. Well, I've heard this. I've heard this from a couple other real estate focused pitch decks recently. Average turnover on a home is 7.5 years, meaning that if you buy a home, you will likely sell that home, move to another one every 7.5 years.
I've heard the same. That's why real estate agents target that type of cycle.
Yep. So you can target that. But here's the challenge. If we have to acquire these 24 million users every single year,
Exactly.
right? And I don't know if the periodicity on that is how long does the average renter stay in a place? Is it 1 year? Is it 2 years? Is it 3 years? People who are moving very frequently might be higher risk clients for some reason. Maybe they're moving because they're getting evicted. They're moving because they can't afford. They're moving, because, right? So there's a lot of things that might come into some selection bias depending on what end of the market we're aiming at. And so I think that these are absolutely going to be investor questions, right? I would absolutely want to know, like, how often do we have to acquire these users, and how many times do they pay us? Right. Because again, we're moving into a not inexpensive customer acquisition space.
I love how we're conditioning founders to think about it. And back to strategic mode, if you could say they stay with us, 24 million, we get them and they stay in our database for every time they move. That's a strategic moat, everyone. It's great.
Yep.
Stickiness. What Ryan talked about, stickiness is a major strategic moat, which is fabulous. So that's the reason you want to calculate all those metrics, such as churn. Ryan, here's a compelling slide. And we're not too sure. I don't think this is from the actual product, but there was a pilot and it was conducted over a year. Now, founders doing a year pilot, that's impressive. Usually founders just don't do pilots, right? They don't understand the value of that, but they collected all seemingly this data over 1,765 members, these property managers, renters, real estate agents, landlords. So it's making me think that, yes, they got the supply side on board. I contested and I said, you know what, and maybe you've got a different opinion, Ryan, but I said, I really don't need this metric because it's kind of like I have like 500 app downloads, but nobody ever uses it. type thing, a little bit of vanity metric. But Will said
Yeah.
if we segmented this and we organized this a little better and explain this, then this does kind of answer the questions that we've been saying is this compelling enough for both sides of the marketplace?
Don't know, because collected a year's worth of feedback. So does that mean they interviewed these people? Does that mean these were the number of signups? But once
Right.
they signed up, what did they do? Housing requests indicates that, people were asking. So it maps to a little less than 2 requests per renter. Doesn't seem like a lot. How many of those requests were fulfilled? Did they match with anybody? We don't know enough of what happened here. This tells a very incomplete story.
Yes,
I
exactly.
love stories that have numbers, and I love the fact that like something happened, right? So yes, there's some traction here, but this doesn't tell a traction story. It just has some numbers. So we need to understand what's the story, right? Relocation pilot collected years worth of feedback to better understand the market, identified shortcomings, and from that created the vision for the AI concierge model. That's not a traction story, right?
Right.
It's not telling the most important parts. Identified what shortcomings, right? How did that lead to knowing that AI was the right way of solving this problem? Did we solve problems on both sides, or is it more on the renter side, right? What do the property managers have to say? What do the real estate agents have to say? What do the landlords have to say? There's probably a really good story we can tell from this. It's just not being reflected here. So without knowing what I don't know at this point, I don't know what other information we have behind this. I feel like with this much contact, other good stuff probably happened. Now, if it turns out this was just, we were running some ads to a landing page and people had to self-identify as a property manager, a renter, a real estate agent, or a landlord, then we've proven that we can get people to sign up for something. But I also want to know, what did it say? What did they sign up for? What did we do? Because clearly this was before the actual tool existed.
Everyone, I know it's tempting to kind of fudge things and make things a little obscure, thinking, oh, then they're going to be interested and they're going to ask me. It works the opposite way around. If you're doing a pilot, explain where and when you did the pilot. If you're talking about, hey, we got this, figure out what is that magic core metric. Like in this case, we've talked about this with Ryan before. In Slack, for example, nobody cared about how many downloads. It was how many messages were sent back and forth.
Yep.
For a dating app, it's not how many profiles are there, it's how many matches were made. And in this case, the core metric that I'd be looking for as an investor is how many applications to placements, right? And unfortunately, we're not seeing that or any indication of this is the direction that we're pointing.
Yep.
And this is precisely what Ryan is talking about. A lack of clarity is going to hurt you.
Yep. It's gonna at least bring questions. Now, questions aren't a bad thing. This is a question that is, to me, if you're going to show this, tell me what the answer was. Like, what was the finding? What came from this? And if it's the case that, look, we're not showing the number of requests that became applications, the number of applications that became leases, because that's not how it was set up. It wasn't structured to do that. What was the pilot, right? We need to know more about the pilot, because we're spending a lot of words here, a lot of screen real estate on this, a year's worth of feedback to better understand the market, identified shortcomings, right? It doesn't tell me anything, right? It tells me that some stuff happened, but not what.
Ryan, based on this, market is largely controlled by 8 major companies operating 25 lease portals. Okay, I like the fact that the founder acknowledged that there's competition. I don't want to get into a competition slide, but we talked about how competitive it is. This is the last section, Ryan. Based on you as an investor, and then also your experience as a chief marketing officer who's been successful in doing go-to-market strategies, we're missing the go-to-market strategy slide. What would you want to see on a go-to-market strategy slide for this pitch deck?
Well, let's go back to, let's talk about what the go-to-market strategy slide is, right? Your go-to-market strategy isn't how you sell. It's proof you understand who buys. Okay. So that's what I need to see here. I need to see that through that pilot, we now understand who's going to buy. If you can show me that, then you can start to tell me the story of, and here's how we're going to get more of them. We're going to go to Meta because that's where this specific population of buyers hangs out, because we already tested that, and Reddit and Google search ads and Zillow native advertising. And we were able to prove out that this was the channel where we were able to reach those very people. That's go to market, right? I want to understand that you know who buys and that you have figured out a reasonable and defensible pathway for getting this. Now, I reference Meta just because I'm not going to dig into the kind of the super specifics around exactly how I think we should go to market here. There's some big lingering questions around, do we get buy-in from the landlords, from the property managers, from the real estate agents, or and are they part of our distribution, or are they just a population that we have to convince to accept our passport, right? Our digital stamp.
Okay, hang on. Let's bounce into that just for a moment. Let's say the pilot was, we worked with a property management company because we know property management companies manage multiple locations. Some of them
Yep.
have thousands of units. And we did that. And here's what we learned from the pilot. And because it was successful, our go-to-market strategy will be we will be contacting other property management companies in the same vein because we've got the network and the referrals and the connections that helped us do the pilot in the first place. That would be a lot more logical putting your concepts together, right?
Agreed.
Okay. But the whole point of it is what you're saying is you can't actually create a semblance of a go-to-market strategy slide unless you actually have some evidence. You've done some research. It can't just be theory that we're going to use Meta because we heard Meta was cool.
We want to see traction. I want to see that something has actually happened. I don't just want to see a list of tactics, right? That doesn't tell me anything. Show me a list of outcomes, right? Show me what you've already tested and how that defines what go-to-market is. Otherwise, go-to-market, you're just guessing, right? And that does not help to instill confidence at all. If you're still at that level of go-to-market, you need to find a way to be scrappy, get money together to go test those things so that you can then go out and raise money against it. Because a really compelling go-to-market slide makes your ask feel inevitable, not ambitious.
Wow, that's good.
Right.
Right.
That's, to me, that's what it does. And then we get to the ask and we go, okay, and I see why. So that's actually, I was going to ask, can we look at the ask slide, the funding slide? I want to see what they're earmarking funds for here. Do we have that?
150K for prototype, 250 personnel, 100K for marketing. Post money values. Everyone, by the way, don't put that there. I just noticed it now. Do not put your valuations. You're just jamming things up. Okay.
Yeah.
So first is post-money valuation. It's not your job to value the company. It's the market's job. They're going to figure that out, smart investors. You're just showing yourself as kind of an amateur. 12-month post-funding running room. It looks like you're just raising money just to stay alive. You want to raise money to get to an inflection point. Current burn 5K monthly. We don't have to put that there in yet. That's going to count to due diligence. Don't put details that are going to work against you.
These are big round buckets. What are your thoughts, Ed? That 250 in the middle is problematic.
Yes, it doesn't make sense. One, listen, if you told me here's the inflection point that we're going to get to and you needed specialized personnel, like that makes sense. But like the rest of the slide, it's missing. I don't want you to jam the slide up and make it more dense. Don't want the pitch deck to get any more dense, but clearer so that we know how to understand the numbers that you're putting out there.
Yeah. Look, my lizard brain, investor brain just goes, show me $1 in, why that's going to turn into X dollars out, where X is greater than 1.
Right. I really liked what you said, though. And let's focus on that. You said, make your ask seem like it's going to be an inevitability. I'm going to compare that to you were just going to pour gasoline on this fire. This fire is going to go anyway. We've already lit the fire.
Yes.
We have evidence of it. Your money is just gasoline to accelerate the inevitability of everything being an inferno. I really like what you said there. For all the people listening, just break that down. What's the first step? If they're like, oh, I don't have a go-to-market strategy slide like this, or I don't have any traction to make an inevitability, give them the first step.
Go get some, right? That's the beautiful thing about traction. You can start making it at any point. I don't care what your argument against it is. I will refute it and I will defeat it every single time, because there's always a way to make what you're going to do next smaller. Make the next step smaller. You're like, well, we have to have this. We have to have that. Okay, you can't build customers yet. Can you build an audience? Right. Can you show me that you're building meaningful community? Could you do it as a service? Could you do it as, like, there's so many things that can happen in there, right? So for example, this could absolutely be run as a service before we go and build a prototype.
Perfect.
Absolutely. You pick one tiny geography and you work with 5 or 6 management companies. You get them to agree to a unified application.
Right.
And then you act as lead gen for them. They will probably be very happy. Right? You are now going to send the people. You can run that as a service. I don't need to build AI. I don't need $150,000 to do anything. I need $10,000 to hire Roger, Sarah, and Jane. That's it.
And on top of which, you probably spend $50 in tokens and give them a custom GPT or some type of tool to use to make themselves more efficient.
Well, think about this, though. In every single case, people aren't like, where can I move nationwide? I need to know the inventory of the entire of the Americas so I can decide where I'm moving next.
Right.
Because I'm going to allow the wind to blow me wherever it goes, and then I will land there. No, you're like, I'm moving here to this town or this city, probably this zip code, maybe this street or neighborhood, meaning that the universe that we have to deal with, I don't need a GPT to do that.
Right.
Now, when I'm dealing with a massive database and it has to be narrowed down, yeah, sure, at some point that becomes very useful.
It's good.
But if we constrain our experiment appropriately, we bring people who are likely to move to that area, we just get the management companies who have houses in that area, all of a sudden the exercise is really small and can be done easily manually. you can just tell me, like, I have this credit score, I want to spend this much money, and I have a dog and I have a kid and I need parking. And I just go beep, bop, beep, boop, boop. There's these 3 landlords that have stuff that's for you, right? It's not complicated. So again, that's not what this person wants to build, but we can bring people in, that we can get them into a unified application. We got landlords to agree to unified application. These are big assumptions later on, right? The idea that nationwide, we're going to be able to get everybody to agree to a unified application. Don't know yet, right? Said differently, if we can't get 5 to do it, then I'm really going to have a hard time believing that you can get 50,000 to do it.
Perfect.
So show me 5.
Love
me
it.
5. So break it down and then show me that story and then explain why. We did this because we want to make sure that we validate this, this, and this. We want to validate that we can find renters. We want to validate that we can get landlords to accept our unified application. And we want to validate that when we do that, people actually get into apartments faster and cheaper than they did before. Sweet. Now I know what you're going to ask me. Your ask is now inevitable as the investor. Now I know what you want is money to go do more of that thing that's already working. And guess what? I'm way more likely to say yes.